what's happened is that a lot of new ideas, new technologies, new things come along, and they make fabulous revolutions, and they grow things, and that's great. But there's a tendency of investors to extrapolate the past and get and not pay too much attention to price. And when that happens, you start to emerge as somewhat of a bubble. By our measures, the bubble is not as what it was in 2000 and not what it was in 1929, but it's kind of like halfway there if I look at the types of qualities. In other words, and so what that means from a value point of view, if you're calculating, what can I realistically expect? Its expected returns shrink relative to the others. However, the kind of the meat and potatoes type of companies didn't benefit as much from those, and they're fairly stable and so on. And so that's why you're starting to see that kind of rotation. Now that can change. It can come and go in these phases, like when people get stimulus checks and then, they might be hot on, the exciting things and they run up again and so on. But that's going on. And of course, there's Bitcoin and other things that are going on. However, the big thing is plenty of liquidity and ridiculously low interest rates. Now, you ask about the 1.6%. I think we have been in a 40-year bull market in bonds. So now you look at that 1.6%. That's a negative 1% about real. Okay, so you're guaranteed. And you ask yourself, if you're going to hold a bond, any investment, the only purpose of an investment is so you can sell it to buy something you want. And so when you look at what is the length of time it's going to take me to get my money back, if I give an investment nowadays in the United States, I'm going to have to wait about 50 years to give back the buying power to start, and then I'll start earning money. If I'm in other countries, some Europe and Japan, I will have less. And if I measured in all those countries in real terms, I'm going to have less money. So basically what that means if I just bought anything that didn't depreciate in real terms, if it just matched inflation, I'd be better off than to have those things. And so now, I don't think those rates will only stay down there, I think, if the Federal Reserve does what it did like in the 1930s in the war period, which is to put a cap on rates, to make short-term interest rates low in relationship to the cap. Like back in the 30s and the war years, they made 1% was the short-term interest rate and 2.5% was the bond yield. So it was profitable to buy those bonds, funding it with 1%, and you got 2.5%, that could put a lid on it. But because those two assets, cash and bonds, were such bad investments relative to other things, there was the movement to those other things still, and then the government outlawed them. I mean, things like gold. They outlawed gold. That's why also outlawing Bitcoin is, a good probability. And that they also established foreign exchange controls because they don't want the money to go elsewhere.
Let me jump in, Ray, because that comment you made about Bitcoin, I mean, so it's a two-part question. Is that in a bubble? Maybe three-part question. Is it dangerous? And what do you think the likelihood of the government outlawing it is? And is that even feasible?
Bitcoin has proven itself over the last 10 years. It proved it hasn't been hacked. It's by and large, therefore, worked on an operational basis. It has built a significant following. It is an alternative, in a sense, storehold of wealth. It's like a digital cash. And those are the pluses. Bubbles are financial assets that have imputed value. It's an asset that doesn't have intrinsic value. It has imputed value. It's whatever we think it is. And if you look at some of the bubbles in the past, a great book is Extraordinary Popular Delusions and the Madness of the Crowds by McKay, 1845 or something. But he talks about the South Sea bubble, and he talks about the Mississippi bubble and so on. It is when people love it. It's the dot-com bubble and so on. And that could be. So when you look at Bitcoin, it's a possibility. It's an alternative because there aren't many such assets. There are not so many assets that might have intrinsic value that can't be messed around. As far as the government allowing it, the history was, banks always used to exist. And then with the Bank of England, they decided that it was in their interest to have a monopoly on banking at a country. And so what we did is every country treasures its monopoly on controlling the supply and demand. They don't want other monies to be operating or competing because things can get out of control. So I think that it would be very likely that you will have it under a certain set of circumstances outlawed the way gold was outlawed. And you're watching that question arise in India today.